In the heart of Latin America, innovation thrives. Startups are shaping the future, and venture capital fuels their growth. But what happens when the next big leap requires more than private funding? Enter the IPO, the initial public offering. An IPO is when a private company offers its shares to the public for the first time. This transition unlocks significant opportunities: access to larger pools of capital, increased visibility, and a stock currency that fuels growth. For Latin America, IPOs are more than a financial milestone. They are a catalyst for economic growth. Public companies attract global investors, inspire confidence in emerging markets, and set the stage for innovation ecosystems to flourish. This journey can be daunting, but that's where HF Capital comes in. We specialize in guiding growth stage tech companies through every step of the IPO process in. Our expertise spans global markets from Silicon Valley to London. With years of experience, we save founders hundreds of hours and millions of dollars, ensuring a smooth transition to public markets. At HF Capital, we believe in the power of Latin American innovation. Together, we can make IPOs the next big step for your company, fueling growth and transforming the region's innovation ecosystem.
Hi everyone, and welcome to this exclusive session hosted by HF Capital. I'm Natasha Ibarra, you can call me Nat, and it's a pleasure to have you join us today. We are excited to explore a crucial topic for company growth in LATAM, liquidity for investors and the role of secondary markets. As interest in alternative funding solutions continues to grow, this conversation with Nasdaq Private Market comes at the perfect time. This session is proudly supported by Startup Links, Quantico, and Capca. Before we get started, I would like to take a moment to introduce my friend and colleague Jonathan Nelson, Managing Director at HF Capital. John, could you please introduce yourself and share more about what we are doing at HF?
Absolutely. I'm Jonathan Nelson, CEO and Managing Director of HF Capital, and we are basically IPO concierges. We are walking companies through the process with a white glove treatment, helping them do everything from finding the right partners, investment banks, the right stock exchange, and the right vehicle for you to get liquidity and to raise capital. So thanks, Natasha.
Thank you. Thank you for sharing this moment with us. And we are also having the presence of Brett Mock.
Yep.
Brett Mock is head of Nasdaq Private Markets with over 30 years of experience in trading, capital markets, investment banking, and fintech. He is recognized leader in the private market sector. As chairman of Nasdaq Private Market International, he connects issuers globally, leveraging technology, data, and innovation to unlock liquidity in private investment markets and drive growth. He previously served as Senior Vice President and Head of Global Capital Markets at MPM International and held leadership roles at Capital Markets Gateway. Brett has been actively involved in regulatory discussions, including congressional oversights during the 2008 financial crisis. Passionate about building companies and helping people, he is also a former national chairman of the Security Traders Association. Thank you, Brett, for joining us.
Thanks, Jonathan. Thanks, Natasha. Buenos dias a todos, a todas. Todos and todas.
Nicely done, Brett. How are you? How are things? Thank you very much for joining us. And I'm excited to have this conversation and learn more about Nasdaq Private Markets. Could you talk a little bit about what is Nasdaq Private Markets? Is it different than Nasdaq? Is it the same thing? Can you talk a little bit about that? Like, what do you guys actually do at Nasdaq Private Markets?
Yeah, sure. For many years, we were a division of Nasdaq. I have a 30-year career in capital markets. During the 1990s and 2000s, most companies would IPO to raise capital, and they'd start as a small cap company, go public, hopefully become a mid cap, eventually graduate hopefully to a large cap, get added to global indices such as MSCI or LTSE or Hang Seng or S&P or Nasdaq 100, and they've sort of graduated to the big leagues. But after the great financial crisis, we had obviously kind of a lull in capital raising, and then Facebook goes public in 2011, and that was really one of the first DECA unicorns. So $10 billion plus valuation company that was a private company for a decade and then went public. Most companies didn't go public at $1 billion plus, and Facebook was a game changer. In the sense that it was such a large valuation privately and then finally went public. And that sort of made NASDAQ realize that they should probably invest in helping private companies transition to a public company earlier in the stage of private. So, and the other concern was that maybe companies wouldn't go public as quickly as they used to. And then you throw in a decade of zero interest rate policies with a lot of central banks globally. So a lot of entrepreneurs and innovators could get access to capital and cheap cost of capital. And so NASDAQ bought an asset called Second Market in 2013, and it was really just an engine to help move, legal documents, stock certificates, and money at scale so that you could service a private company with the liquidity concerns. And that's really one of the main issues with a private company is that as they grow, they're going to need to address their liquidity problems. And so NASDAQ Private Markets sat inside NASDAQ as a division to service, later stage private companies with liquidity concerns. We spun out of NASDAQ Private Market in 2021. That's actually when I joined to help the spin out. And the idea was that this asset class had grown so significantly and there were so many more companies needing solutions that NASDAQ decided to spin the division out and take on outside investment from a handful of global banks such as Goldman Sachs, Morgan Stanley, Citigroup, Allen and Company. And then we, in the last year, added UBS, BNP Paribas, Bank of America, and Wells Fargo, along with a couple of venture capital firms. And the idea is to tap into their distribution capabilities as well as give this technology an operating system to the asset class. And so NASDAQ Private Market is now a standalone company. It is owned by NASDAQ and 8 global banks.
Very cool. And so you've kind of addressed this a little bit before. And so a secondary is being able to sell your stock in a private company before it goes public. Can you double click on that a little bit more? Sure.
I mean, one of the main reasons that employees work at in a private company is to get paid in growth equity, right? I mean, their options are to go work for a public company and get paid in options, invested options, and then have the ability to sell into an exchange or into a market based on their compensation. But top talent engineers, founders, entrepreneurs, are innovators focused on long-term, innovation and long-term growth, and so they get equity positions in their company, preferred and common, and so. At some point, once the employees become vested and once the company is going to allow those employees to sell a portion of their holdings, what do you do? And some companies it's a free for all and employees are on their own. But strategically, more companies realize that they need to address this almost as a benefit to their employees to run structured liquidity programs where they can bundle their employees that are vested and let them sell a percentage. It's usually between 10 and 20% typically, and then do a structured program. And because they're a private company, they can select the buyers, so they can sort of pre-permission the buyers that they would be eligible to participate in a liquidity program. And so that's what we have really pioneered for the last 10 years plus. And we've worked with over 700 companies globally, I think $55 billion. I think this past year, 2024, we ran about 90 different liquidity programs at about $10 billion. So it's an active component of the private markets. What's evolving is the fact that, VCs have vintage funds that need to exit positions after the life of that vintage fund, 7, 8, 10 years. And if you don't have an active or robust IPO calendar or an active or robust M&A market, what do those VCs or PEs do with those legacy positions? They need to sell it because they need to return capital to their LP investors. So there's been a rise of sort of the secondary market, which is not primary. So primary is when the company's actually raising capital, and selling interest in the company. Secondary is existing ownership that's being resold in the secondary market. And so we've built a marketplace globally that has a membership of about 30 global banks and brokers and about 500 global investors, which include VCs, PEs, sovereign wealth funds, family offices, et cetera. And they want to be able to potentially transact or list shares, or employees want to post shares for sale. So we've built a global marketplace for that. It's not an exchange because these are not listed securities. There's not a requirement by the regulators for the company to register the securities, to list shares on an exchange. It's not like that. This is more known as what's called an ATS, or an alternative trading system, which is one level below an exchange, which is really a technology platform that's connected to the broker-dealer, bank, and investment community. And that allows for employees to post shares into the market. And the output of that is you get, a secure transfer of title and money. So if you're the buyer, you want to make sure you get the title of what you're buying in a safe way without someone walking away with that. And especially if you send the money, and if you're sending the title out, you want to get the money for the title transfer. And so at its core, what our technology does is it's a settlement engine attached to a marketplace, attached to a operating system that you can run liquidity programs at scale for. I mean, we've run massive programs over the years in the billions of dollars with thousands and thousands of participants. And that's difficult to do at scale if you're talking about moving legal documents, stock certificates, capital, tax ID reporting, all at scale. And we've built that all digitally.
Wow. No, that's fantastic. And so are your buyers primarily the companies themselves who want to have a program for their employees and early investors to be able to sell some of their stock? Or is it I'm an employee of Big Co and I want to sell some of my stock, so I come to you and try to do that? So who would your specific sellers end up being, or is it a range?
Yeah, I mean, it's a range. I mean, like I was saying before, employees have to address talent retention. They can't lose their top producing salespeople, engineers, et cetera, because if they don't provide a solution for liquidity for the equity that they've accumulated, they can go walk across the street and work for a public company and get paid in public stock and have a vesting period and sell it whenever they want. So that is a true problem that companies do need to address, is that it's about talent retention. And, it's also about employee benefit. I mean, if you're going to pay employees not only in salary and bonus, but in equity, you have to come up with a solution for them to be able to monetize some of that equity after they've been vested, or their options they need to exercise. So a lot of the sellers of this market are employees because they're the ones that hold the equities. The typical seed or growth investors are typically locked up or are looking for a long-term investment horizon, 7, 8, 10 years. So they're not necessarily going to be sellers. Now, the average U.S. unicorn is basically stays private for 12 years. So the duration mismatch is now a real problem because, again, like I was saying, venture capital and fund management have to return LP capital at some point, and especially if it's appreciated significantly. If it's a billion, 10 billion or up type of valuation from a pure portfolio management perspective, they don't want to have too much concentration risk in the portfolio, or they want to monetize a winner. And so they need to have an exit strategy. And again, if there's no IPO or M&A, how do they exit that? And there are other things that they can do, like continuation funds, selling to, stripping out LPs and having LPs sell. And we won't get into all that. But what we do see is the fact that there are more sellers coming from VC, seed, early stage investors, because they need the liquidity to move on to their next investment. But it's primarily mostly sell side, is mostly probably employees. And the neat part about this is, well, we work with companies. We're not a bank. So that's, again, the premise of why Nasdaq spun the company out, was to really tap into the distribution capabilities of global banks. And then those employees can, open an account with the bank, or they can have wealth advisory or high net worth advisory. And those banks then can bring employees or C-suite or founders and help them work on structured transactions to monetize, some of their equity positions.
And so are your buyers the banks themselves, or is it the bank's clients? Like, who would essentially, I'm CEO of a big co, I decide to run a liquidity program or a secondary program for my employees. You guys help me run through that program. You want to sell the stock. Who would be on the other side of that trade? Who would essentially be the buyers of these secondaries that I would be offering as CEO of a big co?
Sure. I mean, you said before that, there are probably later stage companies that will do buybacks because they have plenty of capital to do that. I mean, typically early stage companies don't want to use their own capital to retire shares. They want to keep that capital to stay cash flow positive, or to have, enough funds to get through the next year. But later stage companies that have had a lot of successes will do buybacks and reward, employees, or take ex-employees out and clean up their cap table. And so that does happen, where we'll do buybacks for companies and just sort of clean up the cap table. The buyers that are, typical of this market are usually like existing cap table holders, because they know the company, they have information rights, so they kind of know the performance of the company, they know the management team. And so a lot of times the company will just go to their existing investor base and say, hey, we need to sell 10, 20, 50, $100 million worth of equity for employees, vested shareholders, and do a distribution. And so we'll just run a tender offer, which is really just the ability to transfer ownership from sellers to buyers and its existing cap table holders. But a lot of times, the seed and early stage investors have such a low cost basis, they don't necessarily want to continue to buy at a higher cost basis. And so they're not the buyers. The other thing about that is that as these companies become bigger, that attracts the larger asset managers. Like if you have a $100 to $200 million USD company, a very large asset manager is not going to buy a $1 or $2 million stake. It just doesn't matter. They're too big of an asset manager. But when you get to, a 10, 20, 50, $100 billion company, and you're going to run a program of $100, $500 million, that global asset manager can buy 10, 25, 50 million, $100 million worth, and it actually matters to them. So that's the later stage, is where the sort of global institutional committee starts to really step in and start to do portfolio management. On that point, the other thing I would probably make this point is that, the returns in the private markets have outperformed the returns in the public markets for the last 10 years. And so that's really actually forced mutual funds, hedge funds, global strategy funds to cross over into privates, because the returns are in these assets. And because the IPO pipeline still has not coming, there's just no new origination of supply of new investable deals. So as a result, they have to come over to the private markets and buy those assets in the sort of later stages. As far as the buyers, it's sovereign wealth funds, it's family offices, it's global VCs, global PEs, global asset managers. Here in the United States, this is an accredited investor market. So it has to be either qualified institutional buyers that pass a certain minimum threshold, or if it's an individual or an accredited investor, they have to have a certain minimum net worth, because this is a marketplace that doesn't have readily available access to information or even to price. And price is super important because there's not much transparency or real-time pricing of the asset. If a company raised capital, in 2020, 21, we're now 3 years past that, 4 years past that. Who knows what that company's valued at, and it might be lower. And so that's part of the problem. This market is there's not much price transparency. There's not a lot of information transparency. And so there's a lot of asymmetric information, which really kind of leaves it to the professionals. What we have built with our technology and what we spend a lot of our capital on is producing data and producing price and we're pulling those from source of truth sources, meaning like regulatory filings, state of Delaware filings, mutual fund marks, closed transactions, bid and ask data. And we have a tape D product now that we've released to the market so that investors can actually get a better sense of kind of what the valuation is of that asset, if especially the primary capital raises happen more than, say, 12 months. It's super important. And the data, we believe, is really what fuels this market's growth, because once you get more price information, more data, you can actually start to, mark your portfolio. You can start to do valuations and figure out if it's an investable asset you want to participate in. And that's really one of the critical components to make this asset class grow.
One of the members of our audience, Jorge Varga, asked, some of our portfolio companies have expressed a concern that early investors, mostly friends and family, that gave them a small amount of money for that initial capital, they want some liquidity on that. Is that something where, like a friends and family round or an early angel investor, they have some stock that they want to sell?
I mean, an entrepreneur or innovator has an idea and, can't necessarily walk into a big venture capital firm and say, hey, give me a bunch of money. So they rely on their friends and family who believe in them and have them give them some money so they can start a business, rent office space, hire some people, invest in whatever product they're trying to build or service. And those are usually seed and pre-series A investors. And so on a cap table, they're sort of last as far as liquidation preferences. But the benefit is that they're struck at, probably a penny or, a very low cost basis. And if that entrepreneur innovator, actually is successful at growing a seed to growth company, then yeah, they're gonna benefit from the upsides. I mean, the typical lockup over a seed investor is typically 4 years. That's rule of thumb. They kind of are allowed to sort of vest. There's usually a cliff until the first year, and then every year after that, or every month after that, they vest more shares so that they're eligible to sell. The problem with seed and Series A companies is that there's just really not a lot of market for that, because the buyers don't know the company. They don't necessarily have information rights. The company hasn't necessarily shown a long-term track record. So it's harder for seed and pre-Series A investors to sell that stake in an early stage company. But as that company gets to, let's say $500 million USD, it might be smaller in other domestic countries. But as you get a cap table of investors, it's now, instead of 5 or 10, it's 50 or 100, and the valuation goes up. That means there's more liquidity in the cap table. That means that that's now on the radar of more potential investors. And, when you want to buy something to provide liquidity, you usually, a lot of the investors do it at a discount, and the average discount for secondaries is about down 10 to 20% to sort of price in that margin of error, not knowing exactly what the true valuation is, or not quite knowing all the information that you need. But there are some, companies, or there's many times we see that a buyer will be down 50%, 60%, 70%, because they really need to bake in that margin of error, because they really don't know what the valuation is. But at some point, there'll be a buyer at a price, and the sellers will sell because their cost basis is so low that they can just monetize some gains, even if it's at a discount. And this kind of comes back to one of our core missions, which is, we kind of believe that if your employees at a private company have worked so hard to build that product or the service or that company, and you've been successful at growing that company and having that company increase in its valuation, then it really becomes an employee benefit to make sure that your employees sell at the right price. Because if it's a free for all, or they're on their own, they're not sophisticated, they're employees, they're not investors, they can really, sell at a huge discount and leave a lot of money on the table of their hard-earned work. So that's, again, how we work with the issuers, to structure liquidity programs where employees can participate, educate the issuers on the options that they can do to run these programs. And then the company actually gets the benefit, because when you run a structured liquidity program, because they're a private company, they may not want certain investors in their cap table. They may not want a competitor to buy those shares and then have access to their information, because for competitive reasons, they don't want to share that information to a competitor. So the benefit to the company of running a structured program is taking care of their employees and trying to maximize their price and providing liquidity for them for employee retention. But it's also because they can choose potentially the investors that they want, the new investors. And like I was saying before, as you get to that mid to later stage, you do wake up a much larger cohort of global investors who are actively wanting access to these growth companies and want to buy them.
So is it primarily, so it sounds like the sweet spot is like over $500 million in valuation to $1 billion in valuation, kind of in that range and higher?
In the US, for sure. I mean, there are $900 billion companies, give or take, in the US.
Wow.
There are $1,400 billion companies globally. So there's 600 companies outside the US that are worth $1 billion. If you go from $1 billion down to 500 million, that number is, north of 5,000. And now this is not the local dry cleaner, some farming operation run by a family with lots of land. This is a growth equity, innovative. This is fintech, healthcare, climate. It's now morphing into defense. It's morphing into, and especially with AI now, AI and blockchain are really the third wave. It's Web 3.0, right? So that's all creeping into all kinds of different industries too. So, old industrials were, value companies, not growth companies, but now you're getting industrial companies that are becoming AI focused. And so it is actually going to more and more sectors. But these are growth equity, innovative economy type of companies. They're not the, sort of 100-year-old business that is privately owned.
No, very cool. And so if I, as a buyer, I have a family office, let's say, and I'm interested in maybe taking a look at like what's for sale on Nasdaq Private Markets, like what would be the process that do I create an account with you guys? Do I log in? Do I talk to Goldman Sachs? What would the process for my actually doing that be?
Yeah, all of the above. I mean, again, we're agnostic as far as how you want to work with the counterparty. We offer institutional investors, so family offices and venture capital and global investors, the ability to onboard with Nasdaq Private Market and manage the portfolio. And the reason we do that is because they can call the company directly today and say, "Hey, I'd like to buy equity in your company," and they don't have to trade on an exchange. They don't have to trade through a broker. It's one of the few asset classes you don't need an intermediary to do it. But there's reasons that intermediaries are beneficial. Like I was explaining before, you want to make sure you receive what you bought, or you want to be able to receive the money that you sold, the asset that you sold, and intermediaries are willing to coordinate that so that one party doesn't just walk away from it. Plus, we're very regulated. The other reason is just to have a more fair and orderly process, where instead of just doing a bilateral, you're running more of a market discovery process, and you can then point to a third party like us and say, okay, we found price discovery through a third party that was a fair and orderly way to do it, and then we're following the regulations and rules. Yes, you can work with a bank like a BBVA or a global bank or a regional bank, because again, we're agnostic to that, because we believe that because we're not a bank, we want to actually pull the banking system into this asset class. If you look at every other asset class, fixed income, equities, derivatives, all kinds of structured products, the banking system has the distributions. They're the ones that are talking to high net worth. They're the ones that are talking to family offices. They're the ones that service them, provide services. So we welcome, founders, employees, family offices that work with their custodial bank, their prime broker, some banking relationship to go through them, because they're going to potentially have access to this. And that bank will also be able to basically show them probably more deal flow. I mean, it's a lot of work to source opportunities. You can do self-service, but it's a full-time job. Or you can say, hey, bank, find me this sector, find me this investable opportunity. I care about these kind of companies. Show me that deal flow, and I'll pay you a fee for it. And that's what happens in many asset classes.
And so one of the things that's happened in the Latin American ecosystem in the last 10 years or so, we've probably grown to about, I think the number is now about 40 unicorns. And kind of the first generation of pioneering venture firms are kind of reaching that 10 to kind of 12-year mark. But because IPOs have been so delayed and it's now taken 12 to 14 years for some of these companies to IPO, a lot of the early investors, a lot of the early VC funds are like, hey, I need some liquidity. At the same time, we have other investors who are starting to get into the asset class and saying, hey, I remember when that company pitched me 8 years ago, I really should have bought, but I can't. If like Latin America as an ecosystem, we're interested in trying to kind of grow more liquidity, more trading volume, more early angels being able to sell some of their positions, more family offices being able to buy some of their positions. How would us as the ecosystem go about that with someone like Nasdaq Private Markets? What would be the best way for people to do that with you guys? It sounds like go to one of your banks, or go ahead.
Well, I mean, depends, but I mean, that's super exciting because I mean, I'm now traveling around the world talking to governments and regulators and issuers and banks because this asset class is now so large. It's a $4 trillion asset class.
Wow.
And companies are now realizing that instead of going public and then having to report quarterly earnings and being focused on the short-term performance of the stock price, and the fact that the C-suite and executives, if they have a bunch of bad quarters, they get fired, and you have to bring in new management. More of the founder, innovator, entrepreneur is thinking 5 and 10 years, like you were just talking about. They don't care about this short term, and they don't want to worry about quarterly earnings. They don't want to worry about that stuff, and it's actually a good thing because it actually promotes long-term capital formation, but also long-term innovation. So again, coming back to what I was talking about, how we've evolved is the fact that if you could address some core problems that private companies have, like liquidity, like you just explained, where you need to transfer ownership, doing it in a fair and orderly way that's compliant, it's regulated, it's safe, it's structured, makes all the sense in the world. And that's actually why I'm getting all these inquiries from all over the world. You'd be surprised what governments are actually reaching out about it because they want to incubate more innovation, especially with the rise of AI. So to answer your question directly, I mean, we work with Latin American issuers. And I mean, we see Mexico City being a hotspot for innovation. We have Mexico issuers that we work with. We have Brazilian companies that we work with. We're now seeing a rise in some interest coming out of Argentina and Colombia. So there is a rising tide in Latin America with innovation. In fact, right now we have a Brazilian unicorn where we have some early investors that need, for your reason, that they're selling it. And in fact, I actually need more family offices and more Latin American buyers into our network. So we literally have a live transaction right now where we're trying to sell a stake in a Brazilian unicorn. And we need to find the right buyer or buyers for that. And we need more Latin American participation. So that's a real-time example of how we would need that. And people can come into the NASDAQ website. They can contact me. Or, like I said, I come from the banking system. So again, the banks are very important to this because they have large equity capital market functions. They have large bankers. Those bankers have relationships with issuers. They trust, hopefully, those bankers. They hopefully trust them. The idea is that we want to actually, we are engaging with global banks and saying this is a asset class that you cannot ignore anymore. And we are here to actually partner with you where we can provide technology, domain expertise, subject matter expert, advise, and help that bank run more programs. So again, an issuer can come directly to the Nasdaq Private Market and we can work with them. Investors can come directly to Nasdaq Private Market and join the network, but they can also go through a bank partner. That bank partner may or may not, though, be a client of a commercial partner of Nasdaq Private Market. I mean, we only have about 30 global banks and brokers, and we are selective about that because we are conscious of the fact that you don't want to have too much counterparty risk. And so just like other exchanges or other asset classes, you need to have rules of the road. You need to have regulation. You need to have trusted counterparties. And so this is not an open access market for banks and brokers because we don't want to have disreputable brokers or banks that don't follow the rules. So investors can join, selective banks and brokers can join, issuers are welcome to work with us. But again, we're agnostic about it. If they want to talk to their own banking client, a banking service provider, that's fine too.
Jennifer Castillo in the comments is asking, do you guys have like a dedicated initiative to start promoting in Latin America, or is it just has it been just kind of on an ad hoc basis? Someone in Brazil at the unicorn says, hey, I want to sell my stock, and they ended up approaching you guys, or early investors, or the company itself? Has it been ad hoc, or is this, it sounds like you're traveling the world a lot more.
Yeah.
Are you guys focusing?
I can't necessarily reveal right now what we're working on, but I would just maybe say that we are far down the road with some of the largest banks in Latin America. You should be seeing something out of that shortly. You also have to remember that Nasdaq is still our largest shareholder, and so we still are very, aligned with Nasdaq in the sense that Nasdaq's, talking around the world to private companies about what their path is to go public. You know this, Jonathan, from your relationship with Jack and Jeff and the Nasdaq team. And a lot of times they will come across a company in Brazil or a company in Mexico or a company in Asia or Europe, and that company's not quite ready to graduate to go public. And so they'll just refer that client to us. So as much as we're not a part of Nasdaq anymore, like Nasdaq is a global franchise, and they are talking to companies globally, and they come across companies that aren't ready to go public, and that comes to us. So it's not like there's a ad hoc initiative. We have the network because it's through Nasdaq, and now because we've added so many global banks. I mean, UBS is the largest private bank in the world. Goldman Sachs and Morgan Stanley dominate, IPO listings on the lead left. We have a lot of strategic global bank partners that have massive distribution ecosystems. So they're also bringing in their pockets of, one bank's strong with venture capital, another bank's strong with European private banks, another bank's strong with issuers. I mean, they all have different strengths. And so they're bringing that all to the market too. And that creates an ecosystem. That's really actually what our true goal here is, to create a global asset class, a global network, and get that network effect so that ultimately capital can find each other. Reducing barriers and letting capital find innovation, and letting innovators get capital, and letting service providers get paid for a service fee, and then everyone kind of wins in that equation, as long as you get the growth that you hopefully continually have. But the growth is there. That's what's been proven over 10 years, and it's expanding globally. And again, we're in a third wave now of innovation with AI and blockchain or smart ledger technology. So this isn't a cycle. I mean, I'm not an economist, but there will be cyclicality, but there's a secular cycle going on here, right? And that secular cycle is global.
How fast are you guys growing? It sounded like you guys processed, what was it, 10 billion in transactions last year?
Yeah, we had almost a near record. Yeah, we had almost a near record year. I mean, it's hard to top the sort of end of the free money era, 2020, 21, where, there was literally zero interest rates and things were getting funded, pretty easily with so much capital flowing around. But yeah, last year was almost a near record year. There was a lot of pent up demand because you had a correction going on with the rise of interest rates. And valuation compression. Maybe some of these companies shouldn't be billion-dollar companies. Maybe they should be less. And so there was a lot of pent-up demand. I mean, Jonathan, you're an expert at IPOs. I mean, I'd actually pose a question back to you, because I think I know the answer, but I don't know if I'm smart enough to figure it out. But why are companies not going public?
It's when I was at the SEC, I ended up doing a bit of a study for one of the SEC commissioners of why Silicon Valley gets so much capital, why so little gets invested in the rest of the world. And the answer that we came down to was liquidity. And it's easier, 85 to 90% of the world's mergers and acquisitions in tech happen in and around Silicon Valley. And so if I'm in Silicon Valley, I know someone who has IPO'd. I know someone who was at a company who IPO'd. I know someone who had their company acquired. And so it's a lot easier to kind of get that kind of connections. But as you said, there's 900 unicorns in the United States. There's 300 unicorns outside of the United States, 500 unicorns outside of the United States.
1,400 globally, 900 US. So yeah, 600. Yeah.
And so, if I'm in Brazil, who do I know who worked at Nubank that actually ended up IPOing? So I know how to do that. I think a lot of founders are also just scared.
Yeah.
They're scared of, I've heard of a shareholder lawsuit in the United States. I'm scared of, I've never done this before. How do I do it? I'm scared of how many CFOs out there have actually been through the IPO experience. I've just noticed in the last 10 years that IPOs have become much more daunting for entrepreneurs. Like you said earlier, companies used to list as a small cap.
Yep.
Adobe, NVIDIA IPO'd at like less than a $500 million valuation. I wish I would have bought.
Yeah.
But now VCs are waiting. They're telling their companies, like, wait until you're $500 million in revenue or more. That's kind of madness to me. But is this taking more time to IPO? People are less comfortable IPOing earlier. I think that there's a huge market for you guys, and I'm really glad that you guys are out there doing this. I know a ton of conversations that I had with VCs in Latin America. I'm asking them, like, what's your biggest pain point? They're like, I got great companies, but for the love of God, I need some liquidity.
Yeah.
And so it's one of the reasons that we wanted to have a conversation with you. Jorge Vargas asked, can you talk about the metrics and company size that would be a good fit for you? At what stage would one of a company in a portfolio come and talk to you guys about running a tender program?
Yeah, I mean, that's a really good question, actually. Thanks for asking it, because I mean, because at the end of the day, one size doesn't fit all. The U.S. has inflated valuations. Other countries are going to have lower valuations, maybe less of a cap table. But so we're mindful of that. But you need to have, a double-digit growing company. So they have to be a high-growth company. There has to be momentum. The cap table needs to be, more than 10 or 20. I mean, if it's a handful of holders, you're better off finding a liquidity provider or finding a strategic that you can sell, or hiring a banker to sell your stake. I mean, that's more of a placement. That's more of M&A. And this is not a market that supports that. But as you get to the companies that have an ownership group of hundreds of employees, and let's say more than 20 to 30 strategic investors, you have enough holders of equity. They have different timelines. They have different investment horizons. They have different needs. And so when you get a cap table that is, again, more than 50, 100, whatever, you're going to have to address it. As far as a, sort of minimum, I don't want to say that, because if it's a $200 million, you just said NVIDIA went public at $300 million. I mean, my God, if you were able to buy that at $200, $300 million, you'd be on the beach somewhere, right? So like, I don't want to say this is too small. I think the thing that you need to remember is that a professional investor, like, they're not going to waste their time on something that doesn't move the needle. So like $1 million, $2 million, that's kind of a minimum investment for a professional investor. For larger investments, it's 5, 10, 25. So that's part of the problem, is if you're going to do a 5 million USD program, I mean, you want to find one or two investors that can take down, 1 to 2, 3 million. That's part of the problem, is if it's too small. But it shouldn't. There's no minimum. There's another thing I want to say, which is besides Nasdaq, the largest source of referrals that we get are from law firms, and so the major U.S. law firms, the Cooley's, the Goodwins, the Lathams, the Davis Polks, all those top 7, 8, law firms are all advising, CFO, GCs, and founders of companies, because they've had to hire them to create stock, to create, documents for the company to incorporate. And so what ends up happening is the founders or the executive team of an early stage company really rely on that outside counsel to advise them. And that outside counsel at some point says, guys, like, it's no longer friends and family. It's no longer a couple of people. It's a real company. We're not liquidity advisors. We can't advise you. Please go talk to Nasdaq Private Market. And so our biggest referral sources from law firms for that reason is because they're not the experts on the capital market side. So we sit down with many, many companies. Nasdaq gets many, many companies and refers them to us because they're not ready to be public. Banks get many, many companies and they say, hey, what do we do? And the bank comes to us and says, you guys know how to do this. You have the technology. We don't have the technology. So let us manage the relationship. But we're going to give the company over to you and work with you to structure a program. I mean, we're working on a $300 million massive program right now with the global bank on a very, very hot name sector for that reason. And we're doing capital introduction where the existing shareholders would like to sell and some employees would like to sell. And the company is getting ready to maybe IPO in a couple of years. And they want to bring in new shareholders because it's now a late stage company. And so those new shareholders are global investors that want to have more access to this asset class or this company. And so this is a capital markets transaction, and we're the subject matter experts. We're the ones that can advise the company, structure it the way, partner with the bank if we need to, go out to the network of global investors and family offices and invite them to a program. And then the company, again, can't stress this point enough, because they're a private company, they're very lucky because they can pick and choose who they want. And that's the benefit of being a private company. If you're a public company, you don't get to pick and choose. You might get an activist investor that's buying up your shares. But in the private company, you can pick your investors if you're lucky, you know. So yes, this is a asset class that is here to stay. There are service providers, there's technology, there's solutions to work with companies, and it is going global. And I don't probably want to waste the time today to tell you where I'm going, but I'm talking to Asia, Europe, Middle East, Latin America, and it is all over the globe now. And everyone's learning more and more about how where they fit in this network and in this ecosystem.
And I have probably time for one or two more questions. If anybody in the webinar wants to actually ask one more question, can do that. R is asking, what sort of vehicles are you looking at that are for sale? Do you see people listing like a convertible note is it obviously probably most of your transactions are just shares that are actually being sold?
Yeah, I mean it's preferred and common. I mean, the benefit obviously of, again, I don't want to speak out of line here. I'm not an advisor. I'm not a financial advisor or banker, but preferred shareholders typically have information rights. They usually have the ability to sell. Common doesn't, and that's one of the structural problems, is that common trades at a discount to preferred, and again, it's usually between 10 and 20% at a discount. Information rights are really important, because if it's an ex-employee, employee, or investor, and the company's not involved, the company doesn't necessarily want to share information because there's no benefit to them, and they also don't want the liability of it. So that's one of the problems that happens, is that a early investor wants to sell and the company won't cooperate. And then there's no information in the company. And so the buyer, the investor, is like, well, I can't buy this asset because I have no idea how to value it. And I have no idea what the information looks like in the data. And that's one of the problems for ex-employees, frankly, is when they leave a company and they want to sell their shares, the companies might not cooperate and they're on their own. And that's when they're selling down 50, 70% because some liquidity provider is at a massive discount to just say, all right, I'll buy it down 70, 80% just because. So there's that problem. But in general, I think that, it's preferred and common. Convertible notes are complicated, and I think you have to be a real expert at that. It's not to say that a convertible note couldn't be posted in a network, because again, this is a bulletin board, platform connected to the global VC and investment community. And so people can see an investable asset and say, what is that? But that's going to take a lot of high touch work to get in the weeds on that. SPVs, special purpose vehicles, that's also a really important asset for this asset class, because you can't have one seller face 50 or 100 buyers and have 50 or 100 different stock title transfers, and like, you know, it's one facing 50 doesn't work. So if you bundle the 50 or 100 or 200 into a vehicle, and that's one buyer facing one seller, it becomes a lot more efficient. Plus, companies like SpaceX and Databricks, some of the biggest and latest stage companies, you can't buy common or preferred stock. There's no way you can get it. So the only way for you to gain access to companies like that is through an SPV. SPVs are also really popular with family offices, especially internationally, because they typically don't get access to the primary capital raises that a company will do with a VC. So the best way for them to gain exposure to a growth equity company is through an SPV. And in fact, I'll just share this with you today that we have just launched our SPV product as well, because we're sitting there at the point of sale working with the company. And so we kind of feel like, well, we can probably just get allocation. We don't use our balance sheet. We're, you know, just a pass-through vehicle. But because of our brand, because we're right there with the company, we can get the allocation we need. And we just need to go find better distribution partners and sort of also reduce some of the hidden fees. We see in the SPV world, there's like layers upon layers upon layers of fees. And we want to create more price transparency because our ultimate goal is a more efficient market.
And the last question that I have, Brett, is if I'm a buyer or if I'm a seller, what kind of information on the company's financials do I have to provide? If I'm a buyer, what kind of financial information do I get from buying an asset that's listed on Nasdaq Private Markets, or does it vary?
Yeah, well, that's a really good question, because that's, I would say, one of the core flaws of this market is if you own common shares as an employee, investor, ex-employee, you probably don't have information rights. And like I was explaining previously, if you're not part of a structured program that the company is actually running, where they provide a data room, they provide information, you're on your own. And if you're a common shareholder, you're probably not going to have information rights on the company. You're probably not allowed to share anything you know. And so as a result, you really don't have much to offer other than a discounted price, because you need to monetize it, especially like an ex-employee like has left the company. You know, they have life events. They want to sell equity. It's really hard for them to do that. And so that's a problem. The preferred shareholders, like I said, typically do have information rights when they make the investment, and they probably have been a good shareholder or board member. So they're probably, hopefully, you know, in good graces with the, you know, founders or the management team. And they probably will approach them and say, hey, we have a end of life fund that we need to return capital. Would you please cooperate and help us? And we can potentially present some buyers, and you can maybe even choose the buyers. So you have a choice in the selection process. And as a trade-off, we would need to provide certain information rights to them, because we have to, you know, they're fiduciaries. They need to do their own diligence. On the buy side, that again, the top 30 to 40 unicorns. So again, it's a SpaceX, it's a Databricks, it's an OpenAI, it's Chime, Stripe, Epic Games, Klarna, Canva. The information's pretty well known in the investment community. The valuation's pretty well known. So those things tend to trade with that information because people know enough about the company, their growth, their valuation. When you get to the next, hundreds of companies, which are still unicorns, there's not information flowing around. And so again, the buyers, if they're fiduciaries, need to do their diligence. So they're going to need some sort of access to information. And again, a lot of these companies say, well, there's nothing in it for us. We don't want the liability, so we're not going to cooperate. And so you're at an impasse. And so again, what we end up doing is if we get significant buy interest from buyers, we call the company, because we work with almost every single company that's a unicorn globally. So we probably know them or have worked with them and say, hey, CFO and GC and CEO, there's buyers in the market right now, 10, 20, 50, 100 million, whatever. You haven't done a liquidity program for a while. So it's probably time to do something because you have buy interest. So let's work on something. And so a lot of times you can do reverse inquiries where the buyers say, we want access to this company. And then we approach the company, or we approach the company through a bank partner who has a relationship with the end company, and they approach the company through their banker.
Brett, this has actually been fantastic. I've been in this space for better part of 10 years, and you just gave me a whole new download and a bunch of information that I kind of need to kind of sit and digest. Really want to appreciate you for taking your time. I suspect some people are going to be reaching out to me. I've had 5 people in the last 2 months ask me about secondaries. I suspect we're going to have more people after this. So I suspect I'll be knocking on your door, and people will be signing up on your website to kind of learn more about this. But really want to thank you for your time. You guys have been very generous. Kapka, want to thank you guys, Startup Links, our distribution partners, Quantico VC, great research program, research company in Latino America on Latin American VC. Thank you guys very much. Thanks to the audience, and we'll see you next time. Really appreciate it, Brett. Thank you.
Thanks all.
Cheers.